It's the 26th of February. I'm Adam Khoo. So let's take a look at what's happening to the stock markets right now. And I'll be talking about a fundamental change in the internals of the market and how the market is having a so-called changing of the guard of which stocks are now taking charge and are driving the market forward and which stocks are now taking a back seat. So let's begin with the S&P 500. So if you take a look, you can see that we are now going through a usual correction, which is pretty normal. So after a wave up, you've got a wave down, a wave up. Like I said in previous videos, we are due for correction after a wave up. Now we get a wave down. So right now you can see that we have wave down corrected to this 50 moving average, which may act as a level of support. So it could find support over here and bounce back up. That's possible. But at the same time, if you look at the longer term time frame, which is looking at weekly candles, let's take a look at weekly candles, you will see that, hey, we are still pretty overextended. The market still looks expensive and still quite far from its moving averages. Remember, prices will always come back to its moving averages eventually. That's why we call it an average. It's like a rubber band. When you pull the rubber band, it will always return home, always come home eventually. So you can see on the weekly candles, we are here right now. And we are still far from the 20 EMA, 20 exponential moving average that acted as support. So we could still see some more downside all the way to 3007 on the 20 EMA. Now, if this retracement or correction gets deeper, it is also possible that we go all the way down to the 40 EMA at 3005. In fact, this was previous resistance that could act as a strong support. If we get an even deeper retracement, sure, we could go all the way to the 50 moving average. So what I'm saying is this, the bull market is still alive. It's not a bear market. There's no bear market close, but within a bull market, you will get healthy corrections. And again, I'm not surprised that we still see a lot more downside on the S&P because again, on the weekly candles, we're still a bit overextended. So a drop to this level here, if we go down a bit more, that would represent about a 6% correction, which is okay, pretty healthy. If it drops all the way to 3005, that would be about a 10% correction from the high. And if it drops all the way to the 50 moving average, that would be about a 15% correction. So remember that in a bull market, you could get anything from a 5 to 15% correction. It's very common. Of course, if it goes more than 20%, it's a bear market, but I doubt we're anywhere near that. Now, what I do want to highlight is that this correction seems different from past corrections. Something's really different this time. There's a change in the market internals. What do I mean? Well, if you take a look at the Nasdaq, which comprises most of the tech stocks, it's doing worse than the S&P 500. Previously, the Nasdaq would always be stronger and outperform the S&P 500 and the Dow Jones. But this time, the Nasdaq is weaker. So let's take a look at the Nasdaq. Let's go to NDX. And although the S&P is at the 50 moving average, you can see the Nasdaq has actually already broken below that 50 moving average. Could it go lower? Sure, it's possible. Again, if you look at the Nasdaq, it is pretty overextended as well. If you look at the weekly candles on the Nasdaq, there we are. You can see previous support at the 20 EMA. So we could find support over there. But if it breaks this support, then we could find it going all the way to the next support at about 11,008, or even all the way to the 50 moving average on weekly candles at about 11,000. So what does this mean and why is this so significant? Well, first of all, understand that the Nasdaq comprises mainly the technology companies, right? The tech stocks, like for example, your FANG, your Facebook, your Apple, your Tesla, your Netflix, your Roku, and so on and so forth. Whereas the S&P 500 comprises all the other sectors, not just technology, but it comprises the energy sector, the industrial sector, the financial sector, real estate, and so on and so forth. So again, previously last year, what do we see? We saw that the technology stocks were the strongest in the market. The technology stocks were leading the market. Whereas last year, energy was in the doghouse, right? Energy was going down, industrials were going down, financials like banks were going down. So technology was in fashion. All these were out of fashion. Now, what's happening right now is the complete opposite. Remember, the market is a fashion show. It's like a cycle. Everything goes in fashion and goes out of fashion. Nothing stays in fashion forever. So now it's the opposite. Now what we're seeing is that technology is now going out of fashion. So these guys are dropping the most. And what's going up recently? That's right, those that were out of fashion. So now energy is going up, industrials are going up, financials, banks are going up, real estate is going up. It's a complete 180. This is why it's so important to have a diversified portfolio of companies in different sectors. See, those people put all their money to tech stocks only, especially those overvalued tech stocks like Tesla or NIO, which I warned you about. Yeah, they made a lot of money last year, but right now their portfolio is getting killed because they're all into that one sector. But if you had diversified into undervalued cyclical stocks, like I told you to last year, like JP Morgan, Bank of America, Lockheed Martin, 3M, CME Group, those cyclical stocks, industrial stocks, financial stocks, you'll be pretty happy right now because they are going up as the technology stocks are going down. So what should you do right now? Am I saying you should sell all your technology stocks and buy the cyclical stocks like financial stocks and industrial stocks and energy stocks? No, I'm not saying that. So what's the strategy moving forward? Hang on, in this video, I'll lay out the plan. But before that, I want you to understand what is causing this shift in the fashion show. What's creating this change in the market internals? So this change in the market is being caused by rising bond yields. So what does that mean? See, when bond prices fall, the yields, the interest yields on the bonds will rise. So let's take a look at what I'm talking about. So if you look at the bond prices, if you look at the TLT, which is the 20-year Treasury bond ETF, you can see that it's now selling off. It's on a very, very strong downtrend. In fact, if you take a look at the longer term, you can see how much it has fallen, right? So what happens when these bond prices fall? Well, their yields rise. So yields always move opposite of the price. Price goes down, the yield goes up. So as a result, you can see the yields on these treasury bonds, which are government bonds, have been rising. For example, on the 10-year bond yield or treasury yield, it's risen from like 1.2% to 1.5%, and the 30-year yield has risen to 2.33%. So basically, interest rates in the long run are rising. Long-term rates are rising, and it's creating what we call the steepening of the yield curve, where long-term rates are much higher than short-term interest rates. So what does all this mean? When this happens, it tells you that people are confident that the economy is recovering strongly. The economy is going to boom. The economy is growing. It's going to grow like crazy with this reopening and this vaccine success. So that sounds like a good thing, right? So why are technology stocks going down? And why are commodity stocks and banks going up? Let's take a closer look why. So the recent fall in bond prices has caused bond yields to rise, which are long-term interest rates. So again, what does this mean? What this means is that people expect strong economic growth ahead. So isn't that a good thing? Well, yes and no, depends on how you interpret it. Now, remember that the market believes that with strong economic recovery would come, ta-da, inflation. So that's the fear. The real fear is inflation is coming. Now, has there been any signs of inflation? Well, not really. So consumer price data is not showing much inflation, but inflation is coming from commodity prices like copper prices, oil prices are rising. Now, why the fear of inflation? See, people always feel that when the economy is heating up, prices will rise, inflation. Now, the real concern is if there is going to be inflation in the future, then the Federal Reserve will have no choice but to raise short-term interest rates. Now, of course, the Fed chair has already said that he doesn't intend to raise interest rates at least for the next 2 years, but the market is freaking out and thinking, hey, maybe he might increase interest rates. So all this is always, the market tends to price in the worst case scenario in the future. Or if he doesn't raise rates, he may still cut the stimulus or the quantitative easing. So this is what's freaking out the market in the short term. Why? Because if the Fed raises interest rates or they cut stimulus, question, how would this impact growth stocks? Now, what are growth stocks? Basically, growth stocks refer to stocks that are very overvalued, that are priced for high growth. Now, again, many of these are technology stocks. Not all. Many of them are technology stocks. So right now, as I've mentioned in my previous videos, some of these stocks, like stocks in cloud computing or stocks in innovation, technology, and electric vehicles, for example, they are overpriced. They are way overvalued. They're ridiculously expensive. Again, examples be Tesla, Roku, Zillow, NIO, and so on and so forth, right? But why are these so expensive? Because interest rates have been low. So people justify it by saying, hey, interest rates are so low, so we are, these stocks can be really expensive. But if interest rates are expected to soon rise, we can no longer justify the high prices of these growth stocks. So that's why many of these growth stocks are now falling really, really hard. And again, could they fall a lot more? Possibly. Why? Because they are way overvalued. So you have to be very careful about these specific overvalued industries and stocks, because when they fall, they could really fall by 20, 30, or even 50%. If you just take a look at their charts, which I mentioned in my previous video, the charts look really overextended. Again, this is the cloud computing ETF. You can see the price is like going up way above the moving averages. Remember the rubber band? Eventually, it would have to snap back down, and it's going to quite a long way to go. Disruptive Technologies, which if you look at the ARK Invest stocks, many of them are overpriced. And again, they've got a long way to come down once they start coming down. So these are the ones that I'll be really careful about. They are in a bubble. These are the bubble stocks. Look at alternative energy, right? Look at it going up 90 degrees. It's going to snap, boom, all the way down. Electric vehicles, all the way up, snap, going to come all the way down. Now, don't get me wrong. These industries have a lot of future ahead, right? They've got great long-term future, but in the short term, they are way overstretched. They've gone up too fast and too high in the short term. They have to come back down before going up higher eventually. And again, specific stocks that are way overvalued, I've mentioned this many times before, again, like Airbnb, selling way above the intrinsic value of $60 at $177, right? Tesla, that was at 900, now it's come down to about 690 or 680, but you know what? It's only worth $300. A lot, big way to come down, right? Look at Zillow, priced at $140, only worth $67. Zoom, selling at about 300, now it's 370 or so, but it's only worth $175. So these are the bubble stocks that people have been chasing like crazy because they keep saying, hey, it keeps going up, it will always go up. Remember, nothing goes up forever. Nothing goes up in a straight line. Eventually, they will have to come home down to where they belong. And with this rise of interest rates, if they really happen, you can no longer justify these high prices. This is one of the best charts to illustrate the psychology that people have within a market cycle. Now, people ask me, Adam, where are we right now in the market cycle? What I find is that different types of stocks are within different points in this market cycle. Again, if you look at these high growth stocks, which I just mentioned, they are probably somewhere here in the market cycle. But if you look at other stocks, they could be somewhere here in the market cycle. So different sectors are in different parts of the cycle. So let me first talk about the cycle, how it works, right? So again, every market, whether it's cryptocurrency, stocks, bonds, every market goes through the same exact cycle. So how would you know that you're getting near to the top of the market cycle? Well, there are a few clues. And one clue is that when everyone is talking about a stock and everyone is telling you to buy a stock, it's probably near the top. Now, I don't know about you, but everywhere I go, people always ask me, Adam, you gotta buy Tesla. Everyone's buying Tesla. Adam, you gotta buy NIO. Everyone's buying NIO. Adam, you gotta buy Bitcoin. Everyone's buying Bitcoin. Adam, everyone's buying ARK Invest. ARK is doing so well. Why aren't you buying ARK ETFs? And again, I found over the years that when everyone talks about something, everyone is buying something, right? Gotta tell everyone to buy. That's at the thrill level. So you're getting near the top, right? Especially when people start to buy on margin, which means people are so confident that it has always gone up, you keep going up, that they borrow money to buy shares. Ooh, that's a sign somebody gonna get hurt real bad. And sure enough, you will see the price shoot up 90 degrees and people think, I'm a genius, we're all gonna be rich. What I found is this. See, think about it, guys. People who really make money in the stock market consistently are those with many years of experience, who have really studied how the markets work, who understand fundamental analysis, technical analysis. But nowadays, when I look around, I see young kids with no experience making money, right? And I'm happy for them. But whenever you see amateurs making a lot of money, and they get this false sense of security and they think that we're all going to be rich, I'm a genius. When the average kid thinks he's a genius in the stock market and made 200% last year, let me tell you something. We are near a bubble, all right? We are near a bubble. And when the bubble bursts and it drops, guess what? You'll be very complacent. Don't worry. It's just a dip. It's going to go higher eventually. I'm going to buy more shares, right? Yeah. And then it drops again, then they get a bit anxious. Right? Why is it not going up? Yeah, I'm getting margin calls. Oh my God, I've got to top up my account, I'm going to lose my shares. It drops again, they go to denial. The denial is, hey, it's a great company, it'll go up eventually, it'll come back, right? Drops again, they start panicking. Oh shit, now everyone is selling, I got to get out. And that's when we've got capitulation, when people panic and they sell in fear, and that's when it drops near to the bottom. 90% of retail traders or investors lose money. Why? Because they buy near the top when things are overvalued and expensive. And why do they buy over there? Because everyone is talking about that stock. It's a hot stock. People are telling them to buy. And when they say, hey, it's gone up so much, my friend has made so much money, I want to make that money as well. Because they think in a linear way. They think that if it kept going up, it will always go up. But they forget the market is not in a linear fashion. The market is a cycle. What goes up must come down eventually. So they get in there, it collapses, they panic, they sell at the lows. And that's why most people buy high and sell low, and 90% lose money. So if you want to be the 10% of investors that make money consistently, you got to do the opposite of everyone else. You got to buy when the market cycle of that stock is near the bottom. And that's when people have what we call disbelief. When people say, don't buy that stock. It's not going to go up. Why you want to buy that stock? I don't believe in it. When no one believes in something, that's when you buy it. Of course, provided you've done your fundamental analysis, it's a great company, but it's undervalued because of short-term negative sentiment. That's when you buy these stocks. So again, last year, I bought Bank of America, I bought JP Morgan, I bought CME Group, when people were saying that, why are you buying all these stupid bank stocks? Why are you buying all these financial stocks? Because I knew that it was at the bottom of the cycle. And now, what goes down always comes up. So right now, if you look at the bank stocks, now they are beginning to go into this rally mode, right? Banks are going up, financials are going up. And now that people are getting excited about banks, what do you think I'm doing? That's right, I'm starting to take profits. So I would say that for banks, they are not here yet. I would say they are somewhere here, right? So as they go up higher, I will sell my bank stocks and my other financial stocks. So for example, you can see on my chat group, I sent an alert to my students This was on the 21st of October, and I said that I just added CME at 164 as the price is at the support level. And of course, this was my fill order. And again, check it out on the charts. This was buying at 164 on the 21st of October. Right here, right? So you can see right there in October, I bought it here at 164 at the bottom of the cycle. So right now you can see that it's now all the way up to 204. Am I taking profits yet? No, because it's halfway at the cycle, right? So I'm waiting for it to go all the way up there to the top of the cycle before maybe taking some profits. Another example would be Bank of America. So if you look at BAC, this was again from my chat group. You can see this was the 30th of March last year, and this was my message to my students, added Bank of America at $22.21, 30th of March. And again, you can see Bank of America on the 30th of March, right here. That's right here. So right at the bottom of the cycle, when everyone was staying away from banks. In fact, if I'm not wrong, I think Buffett himself, he was selling banks, and I was buying the banks. I said, buy at the lows when no one wants it, buy it. And right now you can see that it's gone all the way up to $34, $36. And I'm starting to slowly take profits as it's reaching near the top of the cycle. So once again, the key to investing success is to go against the majority, to buy something when it's really undervalued, when nobody wants it, and then selling it when it's overvalued and everyone wants it. Instead of what most people do, which is to buy something when it's popular, when it's overvalued, and then selling for loss when it gets out of favor. So once again, growth stocks are near the top of the cycle and they're starting to come down. And they've got a lot more downside to go. Now, how about defensive stocks? These are a lot of the consumer staple stocks like Procter Gamble, like Unilever, like PepsiCo, like Coca-Cola. So notice that these defensive stocks are also going down. But in fact, they've gone down quite a bit already. And I think that the defensive stocks are near the bottom. Not exactly, but near the bottom of their cycle. They're getting to be undervalued. So why have defensive stocks gone down? Remember, people buy defensive stocks when they anticipate a recession. So last year, when we anticipated a recession, people bought defensive stocks and P&G was flying high, for example, Procter Gamble, right? But now that people are confident in economic recovery, they sell the defensive stocks and they rotate into cyclical stocks. Hence, defensive stocks have come down a lot. Bringing me to the next point, which would be cyclical stocks. So people tend to buy cyclical stocks when they believe the economy is recovering. So cyclical stocks are now the ones that are leading the way. These are the new leaders in the new market. These are the new guard of honor. So what are cyclical stocks? These are financials, like again, banks, insurance companies, stock exchanges. You have industrial stocks like 3M and Honeywell, for example. You also have got energy stocks that have rallied very strongly as well. Specifically, bank stocks and insurance companies tend to benefit the most from rising interest rates. All right, finally, we have got commodities. So commodities tend to rise whenever there's a anticipation of inflation. So if you look at the commodity ETF, ticker symbol DBC, it's been on a crazy rally right now, specifically driven by rising oil prices and copper prices. So what's my game plan as an investor? Well, what I'm going to do is I'm going to start looking to buy some of these growth stocks, but only if they drop low enough below the intrinsic value. So I'm watching this again for it to get to my buy levels. Now, of course, there are some technology companies that are already pretty undervalued, like Amazon and Facebook and Google. I think that they're pretty fairly priced, but I like to buy more if they go a bit lower. But for the other ones, I like it to drop a lot more to build a position. Defensive stocks, I'm starting to buy them slowly because again, they've dropped quite a bit and I think they are pretty much near the bottom of the cycle and some of them are getting undervalued, like PepsiCo, like Procter Gamble. Now, cyclical stocks, I already bought it last year when it was at the bottom. Now it's going up. So would I buy more right now? No, I'm not buying anymore. Remember, the time to buy is when nobody wants it. When everybody wants it and it's rallying, that's when I do not buy. I never chase the girl once the girl runs away. I only, catch the girl when she runs into my arms. So for cyclical stocks, some of them, as they're getting near the top of their cycle, I'm starting to take profits on some of them. But there's some of them where I think that they've got a long way to run, like Lockheed Martin, 3M, and CME Group, and some of these other cyclical stocks like Ping An Insurance, for example, in Hong Kong. How about commodities? Now, I usually don't invest in commodities, not really my cup of tea, so I don't touch oil, I don't touch gold, I don't touch copper, none of those things, right? But I don't really buy energy stocks as well. But I may get into the energy ETF if I see a pullback in the market, because right now it's going up too fast and we always want to buy on a retracement and never chase when it's rising. So let's take a look at some of these growth industries using ETFs. So ARK is a great ETF that holds a lot of these innovative and disruptive technology companies. And again, many of them are very overvalued, and I think that I'll only want to buy if they come down much lower to more reasonable levels. So you can see that, now always remember that a healthy uptrend is one where you see a 45-degree movement in the price. When the price starts to move up this way in a 90-degree fashion, you know that it's reaching a climax, the top of the cycle, and it has to burst before coming back again. So again, if you look at this, now this was something that was more sustainable. You look at these 45 degrees and then boom, all the way up, right? So again, once you get really far from the moving averages like a rubber band, it will always have to snap back. And right now you can see it's snapped all the way to this moving average. So that's the first moving average, which is okay. It's come down a bit, but again, I would only be comfortable buying if it goes lower to somewhere about maybe at $110. I may add just a few shares, but I'll add more shares only if it goes down to maybe about $90 to $100. That would be nearer the 50 moving average on the weekly candles. Another pretty overvalued growth industry would be, again, alternative energy. Ticker symbol TAN. This would be the solar ETF. And again, you can see that same really strong 90-degree move all the way up. And again, it's corrected all the way down to the first level of support. So again, these moving averages act as levels of support, which is where we will add shares in stages, because we can't predict the absolute bottom of a retracement. So we buy as long as it hits these levels of retracement. We call averaging in, dollar cost averaging. We average into our position. So again, for TAN, it's right at this first level. Sure, you could add some shares there if you want to, but again, I'm a really conservative person, so I prefer to see that it goes lower to this level, or even goes all the way down to this level. So these are 3 levels over here. So if I wanted to buy shares in an ETF and I wanted to buy, say, I want to buy 100 shares, I would maybe buy, for example, maybe 30 shares here initially, take about a 1/3 position, another 30 shares, and the last 40 shares over there. So this way, I get to average in at a pretty reasonable price. So wherever it goes to, eventually when it flies back, I get in at an undervalued level. So these are the growth industries. Again, there are many more. I'm just giving you some examples. Next would be the defensive companies, which I told you have come down quite a bit, and some of them are pretty undervalued right now. So one example would be PepsiCo. So PepsiCo is a defensive company, and you can see again, these are the very strong moving averages over here. So right now it's broken that moving average. It's looking to come to the 150, the green, and the 200, the red. right? So I'll definitely want to be buying shares at these levels because this will be the bottom of the cycle for this kind of company, and get in before it flies up again and it starts the new uptrend cycle. Another one would be P&G, Procter Gamble. So again, if you take a look at the cycle, you can see the wave up, wave down, wave up. Now it's waving down. So this would be a great level to add. This would be the 100 moving average, adding at this level. Now, of course, you could also retrace all the way down to the 150. This would be a great place to add as well before it then continues the next impulsive wave up. Remember, always buy on the breathing in and hold it for the breathing out. So these are defensive stocks. Now, next, let's look at cyclicals. And again, cyclicals I won't buy anymore because the time to buy cyclicals was last year. All right, so if you take a look at again my cyclical stocks, CME, which I showed you earlier on, right? I got in here, I bought there, now it's here, we are halfway there, and well, yeah, you could still enter, I guess, but right now we're halfway through the cycle, so I still have some room to run on this one. Another one would be 3M, which is another cyclical stock, right? You can see this was the downtrend, this was an uptrend, and this was the reversal, right? So this was a great time to buy when it reversed trend, and now it's slowly heading back up. This will take a bit of time because it's a slow cyclical stock. Now banks, if I show you the financials, right, you can see very cyclical, right? So I bought the financials here right at the bottom of the cycle, and now it's gone all the way up, and I wouldn't be a buyer here anymore because again, it's no longer cheap, it's getting expensive, and I'm starting to take profits as it goes all the way up. Finally, if you take a look at commodities, and you can use the DBC, which is the commodity ETF, you can see, sure enough, it's on a very, very strong bull run because of what I mentioned earlier on. And would I buy into commodities? Well, like I said, I don't usually buy commodities, but I may trade them from time to time. I enter as a short-term trade, but I won't hold it for the long run. If I'm trading it, again, I won't get in when it's overextended. So currently it's overextended. I wouldn't jump in right now. Again, take a look at the wave patterns, and I'll probably want to wait for it to retrace closer to the moving averages before getting in here. But like I said, it's not something I would usually buy anyway. Finally, if you look at energy, so energy has been a dog for many, many years. It's been at the bottom of the cycle. But now with the economy recovering and with oil prices rebounding, you can see a change in the trend of the energy sector. Now, this is something I have to say that I missed out on. I regret. I should have gone in, but I missed it. Darn it, right? And you can see right now it's at the top. I won't jump in right now. But look at the wave patterns, right? Wave up, wave down, wave up, wave down, wave up. So never buy on a wave up. Again, never chase the girl or chase the boy, right? Always wait for the girl or the boy to run into your arms. You catch them, and then you live happily ever after as it goes back up again. So I am watching this ETF, and I may enter if I see a strong enough retracement back to the moving averages. So there you are. That's the state of the market. Hope you enjoyed it. Adam Khoo, may the markets be with you, and keep watching, and remember to subscribe for more videos. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.